I am super excited today to introduce you to my personal CPAs. Actually, they're not my CPAs. They are enrolled agents, one step above. When these guys found out that I was starting to pivot into the ADU world back in 2017, James and Alan, who have saved my butt so many times, said, "Wow, you ought to be able to save 15 to $20,000 a year on your taxes." And today they've come up with an even bigger program. James, do you still stand by that 15 to $20,000 figure in tax savings?
Yeah, absolutely. It's even better now than it was then. Generally, it's not uncommon to see savings that average between $20,000 to $40,000 a year, and in some cases, if there's other rental real estate, those savings can be even higher.
Wow. So you're
Yeah.
saying even in the design plans, before you spend a dime on construction, how would designs affect your taxes?
Well, it's you get into the issue of how you deduct the cost. Okay, so certain costs that are attributed to an ADU have to be amortized. They have to be added to the basis. Okay. Instead of just like if you spend $10,000 for plans and architect and permits, okay, you would have to add that to the basis of the ADU and deduct it over time. Now, you can make certain elections on amortization and you can do different things, but you take your property and you divide the property into two primary groups, your residence and the ADU. Then you subdivide that into asset groups. And asset groups are defined by the statute, the years of life of the property. You have 5 year assets, 7 year assets, 15-year assets, and then whatever's left over, the residual is 27 and a half years. So if I have a $500,000 property that's now worth, you know, say $1 million, you don't get to use the $1 million. You have to use your original basis. But if you spend $150,000 for your ADU, that's your basis for the ADU. So we get to subdivide that ADU into those different asset groups, and we get to take a portion of your land and the improvements on the land attributable to the ADU, like your fence, your sprinklers, your shrubs, your trees, your sidewalks, your irrigation system, all of those things get a percentage allocation to the ADU because they're part of the common ground. So all of a sudden now we get to allocate that, and then we can allocate your utility cost, your maid, your house cleaning, your utilities, water, sewer, trash. We start getting into all of these details, and we start looking at the percentage of allocation rules. And pretty soon, your $2,000 a month of income, you have no taxable income because all of the deductions, and you get to keep the money because you're not paying tax on it because you set it up correctly.
Wow. And what about the mortgage interest deduction? Isn't that simple, or would you do it differently?
You have to do it differently. You have to do it using an allocation formula. And so let's just say that of the total livable square foot area, we'll use the simple approach. You have 3,250 square feet. And let's just say that 20% of that total is your ADU. Theoretically, using the simple approach, which is usually not the best approach because it doesn't give you the most, but let's just say that we would take 20% of all of the utilities, we would take 20% of all of the insurance, we would take 20% of all of the mortgage interest. The mortgage interest gets deducted above the line before you get to your AGI because it's subtracted from your gross income. So it's a more valuable deduction. 20% of your property taxes. You're going to have the allocation of the property tax, but you're also going to have a reassessment. Now, here's the thing. most people's property taxes go up because they don't make the argument that the property is depreciating the portion that's the rental. And so they don't challenge the county tax assessor to have the property tax go down instead of up because of the obsolescence rules. So you have all of these little nuances that are very important in deciding if you make $2,000 a month and you keep that money, how much of that money are you going to have to pay in federal and state income tax?
You've turned your home into an investment that's now working for you. And
Correct.
this is the advice that you give to professional real estate investors who
Yes.
are making a
Absolutely.
fortune. So you said you wouldn't structure it as just a mortgage interest deduction. How would you structure it? As a corporation, an LLC?
I would probably set up a management corporation. Now, you don't have to change the title if you're living in the property. You don't want to change the title, but you
Yeah.
can certainly set up a business enterprise. And I would set up a management corporation to manage, you know, your business side of the activity for your rental investment, that is your ADU. And I would start looking at different things that you can do under the corporate structure that you're probably limited to do. Now, your income, let's just say that you get $12,000 or $1,200 or $2,000 a month. That's $24,000 a year. That goes on your Schedule E. Let's just say the simple approach. But you pay your management corporation, let's say, $5,000. So you get a deduction. That fee goes to the management corporation. The management corporation does some things that allow you to take advantage of. It's going to be managing, screening the tenants and managing the books and the records and all of the little things that you've got to do. But then you can start taking advantage of accountable reimbursement plans, medical reimbursement plans, all of the things that sophisticated investors would normally do, you might be able to do under your own corporation. And if you have more than this as a rental activity, then I would strongly suggest looking at those planning opportunities. But if you did none of that and just simply did it as a Schedule E, you had $2,000 a month of gross income, $24,000 a year. I would venture in the first 3 to maybe 5 years, if you did just a little bit of planning, you would have no taxable income.
So you guys are preparing a whole detailed program, educational program. Tell us about that.
ADU Wealth Mastery, and it's a free program. Anybody that comes through your channel will get free access and membership access for life. They'll never have to pay a membership fee. Even if down the road we start charging a membership fee, they will be grandfathered in free for life. We've got our Taxing Times magazine that comes out, so they'll get that every month. They'll get the weekly alerts and bulletins on the latest and greatest tax and financial strategies dealing with ADUs. They'll get access to our free webinars, and then access to, when they sign up to the membership, we're going to give them, because they're coming through your channel, we're going to give them our free ultimate guide to ADU owning, investing, buying, and selling. And I think it's about 100-page book. It's soon to be released on Amazon. We're going to give that to them for free.
Wow.
And with that book, we will give them a free consultation and waive the $150 consultation fee because they're coming through your channel and because we love you so much.
Yeah.
You
Yeah,
guys-
there is a lot of materials in there. Yeah, for sure.
You're going to get a lot of goodies.
Yep.
And it's spoken in English, right? No
Yes.
Spreckenzy taxes. So
Oh, yes, yes.
I so appreciate you guys. I know I cannot describe what a great benefit you guys have been to me personally, and what an opportunity this is for clients. We will get you set up and just sending them, people can just enter their information and you'll get in touch with them. There is more to come from James and Alan in the future,
Yes.
but as you even start to design, make sure that you are thinking about your tax implications to optimize your income and be able to maximize your deduction.
And you make a very good point. The sooner that you start that planning process, the sooner you should include the financial and tax attributes, because once we have that information, I've just got to tell you, when we create the financial modeling, that you can see the power of and what that income can do for you in an ADU, it's just crazy, crazy good stuff. And the sooner that you start that modeling, when we talk about modeling, we're taking the ADU and we're doing an actual proximity analysis and evaluation study on the modeling value, not the appraised value. I'm talking about the modeling, financial modeling value of that ADU. And I got to tell you, I've got clients right now and people that we're talking to that they've spent, let's say, 125, maybe 150, 160,000 to build the ADU. We come in and do the financial modeling, and it has a valuation north of $300,000 that we can support because they're looking at a different kind of rent structure. Everybody that uses rent comps for maybe a 5-unit apartment building, you don't want to use rent comps for an ADU. That's going to give you the lowest end. There's a different way to look at your rent, and there's a different way to calculate that would give you a greater value. And you'd probably want to know that, because that could mean an extra 30 to 50% more in rent just by understanding you have a very unique rent model that's not like an apartment. And unfortunately, a lot of ADU owners think like small landlord owners, and they make that mistaken connection that, well, I've had a tenant for a long time, so I don't want to raise the rent. The market should demand that. And what people don't understand is that ADUs actually have a higher rent index in many cases than an apartment building.
Absolutely agreed. Is there a tax benefit to renting as an affordable home? Many cities, including City of San Diego, has the ADU bonus program, and there's also the density bonus program. So if you add units that are rented to low to moderate income, you can add more units on your property. Is there a tax benefit to renting to affordable income?
So what we would want to do is let people know that there's a whole host of those kinds of benefits that have financial benefits beyond just the rent. We also want to look at tax credits. You have federal, local, and state tax credits. If the property and the ADU has solar, you're going to want to look at your solar credits differently. If you do electric vehicle charging and those kinds of things, or battery, you're going to want to look at those tax credits differently. And there are low housing or low income housing credits available in some jurisdictions. So that's part of our analysis when we do that valuation review or that modeling review. If you gave me an ADU on a single family house on a 50 by 100 lot in 92115, I would scrub all of that and I would index that in my study, and I would make that information available to you and how to get access to those credits. Yes.
So you can run an analysis before you even make the decision about whether you're going to do the ADU bonus program or not.
I can tell you how much money you're going to save before you even hammer the first nail.
Yeah, and believe it or not, we're using this as a tax strategy, building ADUs.
Like a tax strategy. So you always say, oh, do an health savings account, invest in your 401k, and now ADUs have been on that list.
Yeah.